Welcome to Hollow Point Trading's HPT Intelligence series, focusing on the morning star and the evening star. This video provides a complete study of the three-candle reversal pattern. Our philosophy acknowledges that no two patterns are equal, as market conditions vary greatly. However, we live by one simple rule: it either is or it isn't. The video is structured into 6 parts, starting with the foundations and moving through the morning and evening stars. We will then examine the lens of time, transition from pattern to plan, and conclude with a synthesis. Part 1 covers the foundations, defining the shape, the story, and the one rule that governs both patterns. Our binary philosophy demands a verdict, forcing the chart to make a clear claim. Avoid the expensive maybe of fuzzy theses, which lack invalidation, stop, sizing, or edge. Define the pattern, answer yes or no, and stand by your plan without regret. A reversal is not a shape, it's a transfer of control. This involves understanding who is more aggressive and how motivation changes hands. The key is distinguishing a true reversal, which ends a trend, from a temporary reaction, a difference only context can reveal. A reversal needs a trend to reverse. Stars matter most at the edge of an extended move, indicating a real turning point where momentum runs out of fuel. In a range, the same pattern is merely noise. Always ask first, is there a trend to turn? The language of the candle comprises 4 prices that form one sentence. The body shows conviction or indecision, the wick shows rejection, and the close is the verdict. A close is a decision and is everything, as it is the only price the next candle inherits. Levels matter because the market has respected them before. A morning star landing on support, or a floor, shows buyers defending ground. An evening star landing on resistance, or a ceiling, shows sellers defending ground. When several levels converge, it's called confluence, which acts as a multiplier. The three-candle story unfolds in 3 acts: the trend, the doubt, and the answer. The trend is the move in force. The doubt, or star, is a stalemate. The answer is a decisive candle in the new direction. Without the third candle's close, the story is still being written. Part 2 focuses on the morning star, the bullish reversal where sellers run out of road. The morning star requires 4 conditions in order: a prior downtrend, a strong red candle, a small star ideally gapping below the close, and a strong green candle closing halfway into the first candle's body. All 4 must be present. There is no partial morning star. The bottom psychology follows a 3-stage story. Candle 1 is capitulation, where sellers give up. Candle 2 is doubt, a stalemate where sellers find nothing lower. Candle 3 is conviction, where buyers step in and the trend reverses. The bottom is where it stops being able to fall. The meaning of a star is affected by its size, the depth of the third candle's close, the lower wick on the star, and whether it sits at a meaningful level. However, the star's exact color, a missing gap, or cosmetic wick length away from the turn, does not change its meaning. The doji morning star, where the middle candle is a doji, represents a pure stalemate and the crispest signal. It is stronger because sellers produced nothing at the floor. The doji version holds the same grammar as a small red star, only the handwriting varies. Confirmation occurs when candle 3 closes strongly green, at least halfway into candle 1, indicating buyer conviction. The pattern is invalidated if the price closes back below the pattern's lowest point, signifying that sellers were not finished. Reading a morning star involves 5 sequential checks. These are a downtrend, a strong red candle 1, a small star for candle 2, a candle 3 close at least halfway into candle 1, and the presence of a relevant level. All 5 must be a yes for the pattern to be valid. The morning star must occur at a meaningful level, such as support, a swing low, a demand zone, or confluence. The more factors that align, the heavier the pattern. The same 3 candles are worth almost nothing in open space. Volume provides the pattern's fingerprint. Heavy volume on the flush of candle 1, light volume on the pause of candle 2, and expanding volume on the arrival of candle 3. This heavy to light to heavy progression adjusts your conviction and size, not the binary verdict. Avoid these mistakes: buying before candle 3 closes, trading without a level beneath, forgiving a weak third candle, or moving the stop below invalidation. Every mistake here is believing a maybe when the pattern demands a yes or no answer. Part 3 introduces the evening star, the bearish reversal pattern, which indicates where buyers run out of air. The evening star is the mirror image of the morning star, requiring a prior uptrend, a strong green candle, a small star, and a strong red candle closing at least halfway into candle 1. Knowing one star means you know the other, inverted. The psychology of the top starts with euphoria, where the last buyers chase. This leads to exhaustion in the star, where buyers find no one above. Finally, distribution occurs as trapped longs sell, powering the confirmed top's fast unwind. The evening doji star signals the purest exhaustion when the middle candle is a doji. The shooting star is a single candle rejection, a weaker signal, and shouldn't be mistaken for a confirmed evening star, which tells a fuller story. Confirmation for the evening star is a strong red candle close, at least halfway into candle 1. Invalidation occurs if the price closes back above the pattern's highest point, indicating buyers are not finished. At the top, demand a little more conviction due to optimism. The evening star must live at a meaningful ceiling, like resistance, a swing high, or a supply zone. Confluence acts as a multiplier here, where buyers run out of air at prices sellers are defending. Reading the evening star involves the same 5 checks, inverted, with an added emphasis on confirmation at the top, since optimism can create false tops. The verdict is binary. 5 yeses, and it is. 1 no, and it isn't. The evening star is the mirror of the morning star, the same grammar, 2 directions. The morning star reverses a low with red star green. Buying as sellers run out. The evening star reverses a high with green star red. Selling as buyers run out. Part 4 is the lens of time, which explores how the same shape read on different timeframes tells different truths. A 1-minute morning star is a brief exhaustion that reverses a small move. A 3-month morning star represents a 9-month shift in control, capable of reversing a generational move. The shape remains the same, but the truth changes with the time frame. Markets are fractal. The same structures repeat at every scale. Use a top-down approach to establish the overall trend and thesis with higher timeframes. Then, use a bottom-up approach with lower timeframes to pinpoint the trigger for precise entry and timing. The highest odds trade is when timeframes are aligned. For example, a short-term pattern inside a long-term trend. Conflicted trades, where timeframes disagree, should be trusted far less and taken smaller or avoided entirely. Always check the clock above before trusting the clock in front of you. Match your time frame to your intent. Scalps are minutes long, using 1 to 5 minute signals and 15 to 60 minute context. Day trades last hours, using 5 to 15 minute signals. Swings and positions last days or weeks, using daily or weekly charts. Never manage below the clock you entered on. Part 5 is titled From Pattern to Plan, highlighting that pattern recognition alone is useless until it becomes a defined, repeatable trade plan. A confirmed star is just the start of a trade. Define your 3 numbers before the click: the entry, the stop, and the target. Entries can be at the close of candle 3, the next candle, or a retest. The stop must be where the thesis dies, and the target is the next structural level. Binary discipline creates an unbreakable chain, from a binary thesis to a precise invalidation and stop, which leads to known risk and proper sizing. This allows you to risk a small, fixed fraction on every trade and accept stop-outs as the system working, not failing. Define R as 1 unit of risk, the distance from your entry to your invalidation. Size your position using fixed fractional risk, ensuring your stop is affordable. Think in R multiples, aiming for 2R or more reward, which allows you to be wrong more than half the time and still profit. Trade management involves 3 stages: scaling out partial profit at the first target, protecting the trade by moving the stop to break even, and trailing the remainder of the position to let winners run. A plan, not emotion, should guide these decisions. The star pattern is universal, but its application shifts with the instrument. Stocks feature real gaps, making them great for daily swing trades. Options require faster management due to theta decay. Futures trade nearly 24 hours, so focus on candle bodies and closes, not the gap ritual. Beware of 4 types of trap stars: the right shape in the wrong location, the almost pattern where conditions failed, the false confirmation, and the higher timeframe ambush. Strip off the costume by asking, is it fully at a level that matters, yes or no? Part 6, Synthesis, brings everything together into a process you can execute on any chart. The HPT Star Checklist guides your process in 4 steps. Step 1. Establish context and levels. Step 2. Verify the pattern. Step 3. Deliver a binary verdict. Step 4. Create a complete plan. If it's not a clean yes, wait for the one that is. Your practice plan moves from pages to reps. Grade historical stars. Journal every read. Run the checklist on a demo, then go live small, and review your trades weekly. Repetition turns the verdict into reflex. The market deals in maybes, but your job is to answer in yeses and nos. Remember the core philosophy: it either is or it isn't. Now, go decide. This concludes the video on Hollow Point Trading Star Patterns. This material is for educational purposes only. Trading involves substantial risk of loss, and you alone are responsible for your decisions.